In this video, I want to explore real estate investment trusts. So what are real estate investment trusts? We want to highlight, the in details what this particular investment vehicle is all about. So real estate investment trusts are companies that own, they operate or finance income generating real estate. They are companies. Their aim is to own, to finance, and as well manage income generating real estate. They provide a way for individual investors to earn a share of income producing commercial real estate without having to individually buy, manage, or finance any property themselves. They make things easier for the retail investor. You don't need to buy any property, you simply invest in them. Then they will do the financing, they will do the managing, and they will run the real estate for you, the real estate assets for you. So how do they work? How do real estate investment trusts work? Number one is the investment structure. Investment structure number one. Real estate investment trusts, they pool capital from multiple investors to purchase or finance real estate projects such as office building, shopping mall, apartments, complexes, hotels, or even infrastructures like cell towers, like cell phone towers. That's what they do essentially. Pull funds, money from different investors and then channel the fund into the purchase of income producing real estate. Number two is types of real estate investment trusts. Types of real estate investment trusts. You have equity real estate investment trusts. You have mortgage real estate investment trusts, as well as hybrid real estate investment trust. Let me start with the hybrid real estate investment trust. This is a combination of elements of both equity and mortgage real estate investment trust. Then let's equally look into mortgage real estate investment trust. They essentially provides financing for real estate by purchasing or originating mortgages and mortgage-backed securities. They earn income from interest. So what they do essentially is they provide finance, they provide the capital, the loan that is used for purchasing real estate, and they charge interest on the amount given out as loan. There is an equity real estate investment trust. This owned and operated, this particular, the ownership structure is this. Actually, they owned and they as well operate income generating real estates. So they earn revenue primarily through rental income. So as tenants pay rents on those assets, on those real estates, the investors get to partake from the rent payments. Number three is income generation. Income generation. Real estate investment trust generates income from rents, from property sales, or mortgage interest, distributing most of their earnings to shareholders as dividends. So the rental incomes, the interest on mortgage, as those funds come in, most of those funds are distributed to the investors as dividends. So by law, actually, real estate investment trusts in the US must distribute at least 90% of their taxable income as dividend. They don't really hold cash. They don't really keep what they own, sort of. So whatever comes in, 90% and above must be distributed to their shareholders. Number 4 is a public versus private real estate investment trust. So publicly traded real investors, real real estate investment trusts do exist actually. So they are listed in the stock exchange, allowing investors to buy and sell shares easily. These are REITs that are that are listed in the stock market. So they you can buy and sell them like you do a typical equity or stocks. There is a non-public, rather, public. There's public non-traded REITs. There's public traded REITs. We've done that one. That one is listed in the stock market. You could buy and sell like stocks. Then there's the public non-traded REITs. These are registered with regulatory authorities but not listed in the exchange. They offer less liquidity, but they are aimed at stable income. The peculiarity here is that you cannot sell them in the open market like the listed or the publicly traded list. So they don't offer liquidity. If you are in, It's difficult to liquidate your investment and go out. And then there's private real estate investment trust. So these are non-publicly traded and generally accessible to institutional or accredited investors. These ones are not for retail investors. They're not publicly traded. They're not listed in the stock markets, and they're accessible to people to high net worth individuals and accredited investors. People that are worth, I think, around $1 million and above, if I'm not mistaken. Number 5 is tax advantages. Tax advantages is a very crucial aspect of a real estate investment trust. So rates actually, usually when it comes to dividend payments, they are typically taxed at. So when it comes to tax consideration, they are typically taxed at the individual investors, ordinary income rates, but they often qualify for a 20% deduction under U.S. tax laws, making them attractive for income-focused investors. So you discover that the income coming in is taxed, but same time the government would allow you to that advantage of still you could there's that 20% tax advantage thereabout offered by the government. And let's look at the benefits and the risk of this particular investment. Benefit of investing in real estate investment trust. Number 1 is diversification. This exposure to real estate without direct ownership. You don't need to own anything directly. Number 2 is liquidity. For those that are publicly traded in the market, you can very easily buy and you can very easily sell whenever the need arises, than owning a physical property yourself. There's income generation, because the dividends are over 90% of the dividends are kind of the rental income kind of distributed to investors as dividends. And there's professional management. Properties are managed by experienced professionals, those who are experienced in this field. Now, let's consider the risk of investing in real estate investment trust. There is an interest rate sensitivity. It's a typical risk of this kind of investment. Rising interest rate can negatively impact the performance of these kind of investments. There is market volatility. Publicly traded REITs can be affected by stock market fluctuations. For those who are traded in the stock market, they tend to fluctuate just like stocks, you know. And then we have property market risk. Economic downturn can cause the prices of property to drop, like what happened during the global financial crisis, where you had property prices went down tremendously. And if it happens that we discover that it will affect property value as well as rental income. So real estate investment trust can be a valuable, part of diversified investment portfolio, offering both income and potential capital appreciation. Whenever the properties are invested in appreciates in value, and then the shares can equally appreciate in the stock market as well, depending on the condition of the assets they are invested in.